So there has been a couple of posts online about a new secular threat to long-only mutual funds. Let me share my take and dissect how that impacts the stock market and your career prospects. Let's dive in. At this point, there are two things that are pretty well known. One is there is a secular shift to passive investing. And the other thing is the active management industry is facing a massive fee compression because most firms, especially in the long-only community, they aren't really adding any value through the cycle, if not destroying value. If you look at their performance over the index, you'll be lucky if they just hug the index. If not, they actually return less than the index through the cycle. So what is the point of paying you active management fee to destroy value? Somehow, a lot of these investment firms are still around, which is astonishing, but it really speaks positively of their ability to market their product rather than their ability to create value for their clients. One respected user on a finance forum said the long-only industry is split into three segments. One is the mega long-only. That will be your T. Rowe Price, Capital Group, Wellington, has a lot of assets because of scale, brand, and distribution. And you have the elite boutiques who generate real alpha pre-fee, and they deserve allocation going forward. Then you have the fat middle. They are the closet indexers. They create no value. They cannot get more assets as a result for creating no value, and they will be the share donor to the above two parties. On a global basis, the fat middle actually comprises roughly 60% of the market. Shocking. And they will face the highest fee pressures and as a result underpay talent, and that becomes a vicious cycle that they can't get the best talent, which then can create the best results, which face more fee pressure. In Canada, the consolidation has already happened. Unlike in the US, the impact has already been pretty noticeable because I guess there aren't a lot of middle market, small cap, and specialty funds left in Canada at all. One big challenge for smaller funds in general is distribution. The performance itself is not a lone proxy for inflows. A lot of specialty managers are selling themselves or doing minority interest deals with large diversified asset managers because of that reason. Insurance companies love this move. The specialty shop gets the distribution channels or even negotiated capital commitment by the acquirer. An acquirer now gets in-house investment people and have the opportunity to make money on the minority stake for investing in a fine business that just lacks scale and distribution. On the flip side, the implication for companies that need capital is if they're small and don't have a growth story, there will be less and less avenue to get capital. No matter how impressive pod shop's returns are, companies aren't interested in talking to them because they turn over their portfolio more quickly than Leonardo DiCaprio changes his girlfriend. And companies want to attract more permanent capital. Outside of large asset management firms, aggregating assets is just challenging. They need to consolidate. Your cost savings are huge. If two $10 billion AUM shops with historically 40% operating margins, if they merge, you can save up to 10 to 15 points of operating margin by even cutting 20 to 30% of your portfolio managers and gain scale on research costs, reduce back office via automation and AI, have a smaller office footprint, and one more idea that has dire implication for all of you who aspire to be a long-only junior associates, which leads to my next point. There is a big article on the same finance forum that talks about the decline of associate roles at asset management firms. Unfortunately, I am in the camp of rather believing the trend is real than not. One of the biggest responsibility for junior associates is building models. And now you have a few pre-built model services and AI, which really could accelerate the death of associate positions. These vendors figured out that building and updating models is a commodity task that most of these junior associates do at funds. And they also know sell-side models are confusing, not granular, without business drivers, and full of mistakes. So they understood the problem. They devised a solution by sending you a pre-made model with updates, or update it for you in your model, likely via an API call embedded into your Excel. This author anticipates less associate hiring going forward, with the incumbent associates needing to support more analysts in the future. There are two broad types of models at long-only firms. One is a portfolio analyst, and the other is a centralized research model. Portfolio analyst, in my opinion, is a little bit better. They support the teams within the portfolio. The analyst might also support multiple PMs, and you might support multiple analysts, but at least you know you're contributing to the performance of a particular set of products within the firm. In contrast, in the centralized model, you're treated like a sell-side research, but just in-house. you don't get to hear how PMs and analysts use your work to make investment decisions. Long onlys already don't have good associate training. Instead, they take a you figure it out approach. And going forward, that makes it so much worse, as analysts likely will increasingly treat associates more like a doer rather than mentoring them to become analysts and portfolio managers. Remember, there will always be more people who can do the analytical work than the ones who can make good decisions. And the decision makers make the big bucks because they influence portfolio construction, which influences how money grows or loses in value. One person said they're seeing associate roles being cut and associates being shared amongst PMs. So it is actually happening across the industry already. We already talked about how the fat middle will cede shares to the mega long only and the elite boutiques. And some user even anticipates mega long onlys and elite boutiques to see headcount reductions in associates. And they're already seeing some of that happening in some shops, and in other shops, associates are not converted to analysts. That said, historically, associate conversion to analyst is a pretty low percentage anyways, because long-only firms like to hire fresh MBA grads. If you're at a top long-only shop, life is good. Why give that up? Maybe the business goes bust in 15 years, but you only plan to be there for 8. You kind of sunsetting into retirement. It's totally fine for you. For new entrants, I always advise to only go for it if you're really passionate about it, because still a lot of people want the job, but the shots on goal just keep declining secularly. It's not a good situation, and there's nothing we can really do about it. So we just talk about the business of long-only investing with the fee compression, shift to passive, and the shrinking headcount. What is the implication of that to the composition of active investor population in the stock market? I was having a conversation with a mentor. With the rise of passive, he is making a comment that the US equity market is just increasingly rigged because large passive share plus the 401k market just keeps pumping into the S&P 500 every 2 weeks. On top of that, clients are going passive and then allocate that capital and the fee budget to private products like private equity. As a result, not many participants are left to care about price discovery. The market has become increasingly flow driven. If you follow the stock market at all, you start to notice how wacky the stock market has become over the past few years. And the only pocket of active investing landscape that's seeing rising popularity in capital inflow is the multi-manager. No one can deny the amount of value the market neutral types have created during the last few years. The implication for the market is an investor base that's increasingly short term, in spite of them saying, oh, we're long-term investors. When I work at my prior job, every time I got on a call with company management and have to introduce my shop as a private equity approach to the public market, I threw up a little in my mouth because I know I wasn't telling the truth. And you know what? Company management knows you aren't telling the truth either. If you have ever worked in sell-side or buy-side equity research or in investor relations, I'm sure you know that feeling. With the bulk of the stock market now made of passive and short-term investors focusing on any rate of change that gets extrapolated into perpetuity, and the normal state is inflated valuations. The lows don't get low enough and they don't persist long enough, which creates a lack of reinvestment options, which has been the biggest challenge for long-term investors. For example, Meta looked really interesting. The stock went down to $100. The analogy here is Google circa 2013, when Larry and Sergey were throwing cash on moonshots. An investor got pissed, but couldn't do anything because of the dual class share structure. Google hired Ruth Porat as CFO. Things quickly changed in terms of financial discipline, and the stock started working. So for Meta, the thesis is either Metaverse needs to start delivering or they will have to stop the spend. Thankfully, the latter happened as Zuck came to his senses. And despite founder stock, I can imagine he has to have felt the pressure from top holders like Brad Gerster from Altimeter. And when company like Meta compensate heavily in options, they have a big problem when the stock tanks because it impacts employee retention. As a result, Meta cut costs and Metaverse capex, and stock went up big time. It's great for the rest of the market to revalue the name, but then the momentum players got involved and shot the stock to $300. Now you have another type of hard for the same stock. It's kind of fully priced. Where do you allocate the proceeds by selling Meta stock? If you're an investor whose holding period is 1 year, you take the profit, and where do you allocate the capital when the rising tide has lifted all boats? To my mentor, one of the durable edges left is taking a truly long-term perspective and identify businesses with structural competitive advantages. You also need to find smart allocators who are willing to stick with you for a long period. And look, I'm not delusional. I know that's easier said than done. The challenge challenge is, first of all, finding these businesses at attractive prices and able to find a few similar setups each year, because otherwise clients don't have the patience for you to sitting on cash waiting for the market to come to you. Well, the other challenge is finding those smart allocators, which I suspect is a rare and a dying breed. That's what me and my mentor believe how you should do sensible investing. Even then, shift to passive is not stopping. When an active strategy takes in more assets, it actually hurts their alpha generation ability because the opportunity set is getting smaller. Indexing advantage is actually compound with scale. The more assets you have for passive, the more efficient you can operate and the closer you can track the index, as you can rebalance more frequently and have lower trading costs because you have more bargaining power against brokers. You can also internally cross-trade without incurring any transaction cost. And you can pass those efficiencies to clients with lower fees, which makes more attractive than active products, creating that flywheel. It's kind of like the Walmart of investing. And as a side note, you now have a huge profit pool in securities lending that you can access when you have 1 trillion in assets. So that's where we are. I don't have a crystal ball. It will be interesting to revisit. I think a well-functioning market needs the right balance of market participants with differing philosophies. I was never an opponent of the disappearance of short-term investors because we need them for the long-term investors to get entry prices. Too much passive is problematic, and too much active is also problematic, especially when a bulk of the industry wasn't adding any value. And let's revisit years down the road and see how the public market investing landscape changes. Let me know in the comment what you think. Now, if you want to better understand what it actually takes to break into and do well in investment management, be sure to check out the 2 videos in the next screen. If you found this helpful, please give it a like and subscribe to my channel for future contents on equity research, business analysis, and career advice. I'll talk to you next time. Peace.